This conference will now be recorded.
All right, good afternoon, everybody. Welcome to today's slightly later midday webinar. We're looking to trade the non-farm payroll data release. So hopefully we are aware that we have got data coming out today. We have got some relatively high impacts. It's generally considered some of the more volatile data releases around, which is non-farm payrolls, unemployment rates, and average hourly earnings from the US. So three big data releases from the US all coming out at 1:30. Now, we also have some Canadian data, which we'll come on to afterwards. This is coming out at the same time and the same kind of data: average hourly earnings, unemployment, and employment change. So similar data coming across from both. We're going to be focusing mainly on the US data. US data, US dollar generally going to carry the most weight. So we kind of touched on this briefly yesterday, and we had a bit of a talk through what the implications of these are. We're kind of going to be looking at this data through the lens of inflation and what it means for the Fed going forwards. So we've got three main figures. Average hourly earnings, as it sounds, how much we are earning on an average basis in America, obviously, per hour. We have got non-farm payrolls, which, as we said yesterday, is the creation number of new jobs created in the previous month of December, excluding farm, agricultural, and military on the basis of the fact they are seasonal. They would skew data through certain parts of the year. And then we also have unemployment. So what is the percentage of unemployment in the US? So all three of these data are going to come out to provide us an idea of the current conditions of the labor market in the US. So some very important data and very big data, especially for the Fed when it comes to their decision making. Now, at the moment, the Fed has been cutting interest rates relatively aggressively and consistently from the beginning of their cutting cycle. However, recently they have started to kind of slightly backpedal and say they are going to potentially hold interest rates and or a rate hike is not necessarily off the tables. So that's the position the Fed is currently in. It would be considered a slightly more hawkish stance. They want to hold interest rates to ensure that inflation continues to move down at the pace they would like it to. What they don't want to do is decrease rates too quickly, too aggressively, and then inflation goes back up, and then they're in a pretty bad position. So when we're looking at this, we're going to be basically just thinking on a very basic stance. What would the implications of higher earnings and more jobs and more people working, what would the implications of this be on inflation? Right, so if average hourly earnings went up, more people are earning more money. This would likely cause, or could be a cause, of higher inflation. More people are earning more money, and they're going to be spending more money. Non-farm payrolls, as well as we get a higher non-farm payrolls release, more jobs being created, more people working, more people earning and spending money, potentially higher inflation. And the same goes for unemployment. If unemployment rate goes down, we might see more people working and ultimately spending more money. So that's kind of the direction we want to look at this at the moment. Anything that would be a stronger labour market and more people working would mean the Fed is more likely to hold interest rates and maybe even talk about increasing interest rates again. So anything higher or indicating a stronger labour market, we would expect to see a stronger dollar on the basis of what that means for the Fed. Stronger labour markets, the Fed can't cut rates yet because if they do, it's going to mean inflation could come back up. If we see a lower figure for non-farm payrolls, lower figure for average hourly earnings, and a higher figure or the same on unemployment, that would be an indication of a weaker labour market. There's less people working. The process of increasing interest rates, as we said before, is ultimately to dampen economic activity. And with that, we are going to see a reduction in employment. Labour market is going to weaken slightly, which is the trade-off that they have to make when it comes to bringing down inflation. But the Fed, obviously, their entire job is the process of creating a stable labour market, a healthy labour market, and also price stability. So they want to make sure inflation remains at their key level of 2% and doesn't go too low, doesn't go too high, allowing consistent growth, whilst also maintaining a high or strong level of employment. Now, during these hiking cycles, they are trying to decrease inflation by increasing interest rates and ultimately dampening economic activity. And that in turn is going to harm the labor market, right? So if this came in super weak and we got high unemployment, non-farm payrolls was terribly low, average hourly earnings was down, that could, you know, be an indication to the Fed to say our current interest rates are potentially harming the labor market too much, and we might have to step in to reduce those interest rates to essentially allow the labor market to stay alive. This is the direction we're looking at this at the moment. So higher figures or stronger labor market, strong US dollar, and lower figures, lower, weaker labor market, weaker dollar. Now we've got the figures through here. We've got a pretty consensus across the board seems to be relatively negative. So month on month average hourly earnings is down by 0.1%, remaining the same at 4%. The non-farm payrolls is lower from the previous of 227,000 to 160,000. Again, we are looking at this in relation to the consensus as opposed to the previous, but the fact that decreasing gives us an idea of what direction we're heading in. Unemployment is set to remain steady at 4.2%. So yeah, looking at the consensus is more than anything else. These consensuses that we have on this calendar aren't the only consensuses. So the way in which we get this consensus is essentially an average from lots of different institutions. Lots of institutions will provide their analysis, their consensuses of what they think is going forwards through analysis. We then will get a kind of general consensus, a general average of what the midpoint of those wider consensuses are. So, for example, with non-farm payroll, 160 is the general consensus, and this is what we want to be above to get a stronger dollar or below to get a weaker dollar. Now, if we come in at 160, the market has priced 160 in, and we're probably not going to see the biggest move, which for our trade at the moment isn't going to be the best. So we really want to see a beat on the consensus or a miss on the consensus to get the best moves in either direction. We don't care which direction, we just want a miss or a beat, so we get a move. Now, in order to get the biggest move possible, like this could go to 170, which would be relatively bullish. But in order to get the biggest moves possible, what we would actually want to see is as we get the different consensuses from all the different institutions, some will have a consensus all the way up here, and that will be here, which is 200,000. Somebody thought the consensus could be 200,000, and the low end of the consensuses was 120. We then have the middle kind of 160 average. So that was just the highest and lowest that was provided. Now, in order to see the biggest possible moves, we would like to see the actual figure being outside of those high and low ranges. That would be the ideal scenario. Obviously, it's less likely, but it does happen. If we come above 160 and we're within 200, we're still going to see bullishness. Likewise, if we come beneath 160 but above 120, we're still going to see bearishness. But to see the biggest moves, we would be completely outside of this range from 120 to 200. Best case scenario, really, but we'll see. Yeah, so we'll have a look at a couple of different assets in a moment and we'll see what the implications would be. This average consensus kind of is the same for unemployment and average hourly earnings. So unemployment, a low of 4.1 and a high of 4.4, and average hourly earnings, a low of 0.1 and a high of 0.4. So a bit of a range there that we're kind of looking and taking into consideration. Ideally, above all of them, not necessarily. As well as that, we really want to see that these all come in line for the same consensus. So if we got a mixed bag and we had, let's say, average hourly earnings were down, non-farm payroll was up, and unemployment was also up, that'd be a bit of a mixed bag. Some things are positive, some things are negative, and that could cause the markets to move in quite a choppy way, which is not going to be the best for us here. So, ideal scenario would be we beat the range of consensuses, and we also have all of this data coming in line in the same direction to give us the best move. The same is true, obviously, for the Canadian data. An asset that's interesting to trade around this time, but it could be a little bit harder to get everything in line at the same time, would be dollar CAD, right? If we could get a strong print for the US and a weak print for the Canadian dollar, we have both of these two things coming in at the same time to cause the biggest moves. But there's obviously a lot there that needs to line up. So we'll talk about, we'll put a trade on that, but we'll see how it goes. So this is basically what we're looking for today. We're going to take a trade on this, and we're going to be doing this in a couple of different ways, both of which are straddle trades. So we're going to go through these straddle strategies a bit later on down the line. But we'll quickly go over the strategy at the moment just so we know what we're looking for. A straddle strategy is essentially going to be an unbiased opinion, an unbiased trade, by which we expect there to be a move. In this case, data is going to be the catalyst. We expect there to be a move in a direction, but we just don't know which direction. And we also don't really care. So what we are going to do is we are going to establish a range in price, generally 1 to 2 hours worth of data. We are going to look to place an order above this range to go long with a target of a 2 or a 3 to 1. We'll go for a 3 to 1 when we do it. And then a order to also go short at the same time. Now, what this allows us to do is to essentially catch this volatility as soon as it comes out. We will never be quick enough to look at the data and to pull the trigger because there's obviously lots of algorithms that will be able to pick this data up before we can even think about it, and they'll already be in the positions. So this move happens almost instantly, and for us, we don't really necessarily need to see what the data is first. If we have these positions above and below the range, if the data comes out positive, we might see a massive shoot to the upside, and we get entered into our long position and we cancel the short position order. And then obviously the other way around, if we get a weak print, we shoot through the bottom of the range, we get entered short, and we close the opposing order. So we're unbiased in which direction this goes. We'll have a look at options strategy as well. This is just standard orders. We'll place the orders in a moment and we'll do an options one as well. A few potential issues with this strategy, and one we've had this a couple of times when we've done this straddle before. If this data comes out and it's not very clear and it's choppy and whatever, we might see that the market does this. That then means we could end up taking a loss on the long position and also the short position, right? So this is a good strategy, but it does come with its risks. We could see the choppiness. We could also find that if a strategy is not ranging into a data release, as it normally would, normally, as we kind of tell you guys, don't enter a trade right ahead of a data release because it ends up being a bit of a gamble. You don't know which direction the data is going to come out, and we're in the trade before it. Now, that is a kind of industry standard. You wouldn't rush into a trade right before a data release. This generally creates a bit of a range in price. But if we don't have this range, it means there is nowhere for us really to put the orders and to place the positions. So a trending market is not going to be ideal. We might also find that if this data is so aggressive that it shoots through this range and there isn't the liquidity to enter our position where we want to. In other words, I wanted to buy my position here, but there was no one, I wasn't able to get the position there because everyone's going in the same direction. Nobody's actually selling at this point. That means that my order might be shifted up. And instead of getting entered here, I actually get entered up here. Another possible issue. Last one is going to be the spreads. So when we're looking at a asset price, we're looking at the middle price of this asset. Now around the asset price, the mid price, we've got the spread, the price at which the broker provides us the buy and the sell. Now, based on the asset, based on how risky it is, how volatile it is, what the asset is, this range of spread will either be very tight at a good price or quite large. Now, during times of high volatility, this spread will often increase because it's perceived to be more risky, and the broker wants to make their extra bit at that time. So one thing that could happen, and we've had happen before, is that this spread actually increases outside the range, and we get entered into the trade before it actually breaks out. So that's another potential issue. So that's just a few of the issues that can arise. Otherwise, new straddles can be very profitable. You can get some extremely good risk to rewards through these, and the trade will generally play out within a few minutes, subject obviously to how the data comes out. Now, with all the risks that are associated to this particular type of trade, we can also do a different type of straddle, and this is going to be an option straddle. Sorry, just on timeframes. I would normally look at this range on a 1 minute chart. Reason for that is just so I can see how is this market actually moving in this range, and on the run up to the data release itself, what's the market doing? Now, an option straddle, for lots of us, we won't know what this is, and that's absolutely fine. For an option straddle, we're essentially buying contracts in the underlying, or essentially an agreement that allows me to buy or sell this asset back at a price that I've previously agreed upon. Now, a call contract allows me to buy back at this price down here, where the red line is, and a put contract allows me to sell at this price here. I'm essentially reserving a price without actually owning the asset. What this means is that I hold this contract until the end of the day. If this asset goes on side, I am allowed to essentially go to the IG and say, give me this price that I've previously reserved and enter me back at this level. Now, this is good because we don't have any stop losses. We don't have a stop loss because we are not actually in a position as such. We don't actually own the asset. We're not in a trade. Our risk is limited to how much I've paid for the contract. Now, this is good because it means the risk of what's called whipsaw, or the risk of the spreads increasing, or slippages, or if the market's not ranging, none of that matters anymore because we are just reserving a price that we can then come back to later in the day to buy or sell the asset at. So it eliminates all the potential risks of the previous strategy. Only problem with this is that we have to pay for these two contracts before we enter the trade. So if I paid £100 for this and £100 for this, it would normally be done in pips, but if we paid this much for those two, this market would have to move a minimum of £200 in order for us to make back what we've paid for the contract and to then start making money. So for this strategy, we end up with a break-even zone. I am allowed to buy or sell back at this red line, but until this market exceeds these 2 points, I am not going to make any profit. So we need to make sure we have a very big move on those types of data releases. Now, this can be traded on any asset. So in terms of the implications of what assets we're looking at, sorry, it's back on this. Normally, we would do the straddle on one asset, a buy above and a sell below a range on the same asset. We're going to do it slightly differently, and we're going to do it across two assets, one for dollar weakness and one for dollar strength. So we got an order to go long for dollar strength on one and an order to go short on dollar strength on the other. Basically, just spreading the straddle across two different assets to try and get the best potential outcome in either scenario. In terms of what we're looking at, obviously currency pairs, dollar strength or weakness. For euro dollar, we're going to be looking at dollar strength. I would like to see a continuation of the longer term downtrend if we get dollar strength. If we get a higher print, we should start to see this continue lower. Since we're in a longer term downtrend, that would be ideal. The range here is not particularly good. If we held within this area, that would have been perfect, but we didn't, and we are starting to move, and we're starting to get some volatility before this data comes out. That's not ideal, so we'll see how this turns out. We're looking at gold as well. The gold would then be for dollar weakness. So dollar weakness, this is just on the basis of how gold is priced. So gold being priced against the dollar. If we do see dollar weakness coming through, we would expect to see a bit of a move there on gold as well. So it's kind of the way in which we're looking at it is in a similar way to the currency pairs because it's priced against. Now, I'm not super keen on trading the indices at the moment. That would be another asset class that we could choose to trade. A couple of other ones I was looking at was either cable, and if we get a nicer range on cable, we could look for the short position on that as well, or dollar Swiss. Again, lots of the pairing currencies are very weak at the moment, so dollar strength across any of those would be preferable. Not really that much to go against on dollar weakness, really, but we'll see. Dollar CAD is actually ranging quite nicely, but anyway, so indices, yeah. So indices, we'll kind of be looking at this again in the sense of an inverse correlation to the dollar. So if we saw a dollar strength move, if we saw a higher print, that would be a stronger dollar and a weaker index or weaker stocks. Now, I don't particularly like to trade the indices on this employment data just because it's a bit contradictory in the sense that we get higher employment, stronger employment data, which means a stronger dollar, which means lower indices, but it's also high employment, which would generally be good for indices. So it's weaker on the basis of what does that mean for the Fed and what does that actually mean they're going to do in their next move. And if that next move is holding rates, that is ultimately bad for stocks, bad for indices, and we could see that move down. That reason I personally don't particularly like to trade those in this particular context on this particular news release. Now we are going to place a option straddle on dollar CAD. Like we said, dollar CAD has got lots of variables going into that trade. Data coming out from both countries at the same time. So the potential for a choppy move is probably slightly higher, but the potential for a bigger move is also higher. So it's kind of the ideal scenario to use options because we have a good potential to move further. And it also doesn't matter if we end up chopping around at the start. So for the option straddle, what we're going to look to do is buy both a put and a call at the same strike price. I would generally go for the strike price that has the slightly tighter spread between the put and call prices. So in this case, we're paying 28 pips for the call contracts. So if we were doing, say, £250 per contract or thereabouts, I'm going to do the same size on each one. No, I'm not. I can do 9. Cool. So we've got a put and a call, both with the same strike price of 14410. This asset would need to move a minimum of 60 pips in order for us to make any profit because I paid roughly 60 pips between both of these. So I need to move that distance before I make any profit because that is what I've paid for those two contracts, 60 pips, or just under 60 pips. If we remain within that 60 pip range, we could end up losing both of the contracts. One would be kind of less of a loss, one would be a little bit more of a loss, but we would end up with a negative total P&L between those two. So these are currently running at a loss because we just bought the contracts and we have to move the distance. We've traveled first, so we paid 29 pips. We have to move 29 pips to earn that back. But we could hold on to these contracts till the end of the day, and then we could close the trade, right? These contracts are daily contracts, so they will automatically close and cash settle at the end of the day if we do nothing with them. But for now, we'll just we'll leave those on. Cool. All right, let's put this there. Now, a good thing about the option straddle is you can do those trades a bit earlier. We could place the option straddle now because it doesn't really matter if the price moves in the meantime. We haven't got a stop loss in place because we've just bought the contract. Conversely, for the straddle, normal straddle, we would have to do this trade just before the data release comes out. Reason for that is if we get entered in this trade before the data comes out, that position ends up being just completely against the strategy, right? We haven't been entered on the basis of the data release, we've been entered before the data release. So we want to make sure we're doing it as close to the data release as possible. Now, where are we here? Let's aim up towards, we'll just go for a set kind of, let's go for a 2-to-1 risk to reward to begin with. If we get a nice move, we could potentially extend it if we have the opportunity to. Now, this is going long on the basis of dollar weakness. And we will do £250 risk on the long trade there. Stop loss behind the low of the range, entry above the top of the range. It would need to break out through that first in order to enter that position. And then we're going to do a short position on euro dollar on the basis of dollar strength. So ideal scenario will be that whichever direction this comes out, whether it's strong or weak, we're going to catch the best move in either direction against a weak currency or against a stronger gold. And we'll do a similar kind of 3-to-1. Okay. Or 2-to-1, sorry. 2-to-1, similar risk. Ooh. And we'll put that in now. Might be a little bit early, but we'll put it in. I'm also going to do the one on cable, provided it's still in quite a nice range. If we do it either side of this so we can see what it would look like normally. Stop us above there. 30. And then, yeah, for a normal one, if we're doing both sides of the same asset, we would do the entry where the stop loss is for this one, and the stop loss where the entry is for that one, and then otherwise everything else would be the same. So that is there. So this straddle, order above to go long, order below to go short, a nice tight range on cable, which is the ideal scenario. These two, the ranges aren't as tight, but we've got it in one direction as opposed to both on either side. Now we've got what's time? We've got 50 seconds until this data release comes out. We will try and keep an eye. I'll try and call it out as it does come out so we can see what is going on. Again, we're looking for higher, stronger data across the board for our euro dollar trade and weaker data across the board for our gold trade and diverging data for dollar CAD. If this comes out choppy, we might be in a bit of a sticky situation, but we'll see how it goes and we'll have a talk about it after that comes out. Let's see what we get. Hopefully it's a good print. And we get a bit of volatility before this happens, so you do want to make sure your orders are a decent distance away. Ooh, there you go. Okay, so print came out 256 for the non-farm payroll release. That has, well, smashed the target, and we didn't really get the chance to move it. So, not necessarily a bad thing, but that's, and same thing here. Smash the target in about half a second. So we would now delete the opposing orders for the other sides. That can go, and gold order can go because it didn't come out weaker. We have got the two trades in the bag, 450, 500, 1,000 total, and that's it. Lovely print though. We got 250. It came above the consensus. It came above the consensus of 200, the higher end of this range, which is good. We got unemployment lower, pretty big. That's been holding at 4.2 for some time. So unemployment lower, non-farm payrolls higher, and average hourly earnings down. But the other two were much bigger, right? So a very big data release. Very good stuff. I'm also short euro dollar, so I'm happy about that. And yeah, that's it. That's a straddle trade. So as I said, a good opportunity to catch a very big move very quickly. This is the ideal scenario of what can happen. We probably should have targeted a bit further and adjusted the trade as we went, but oh well, take it and go, and that's uh, that's all good. So that is that trade. Dollar CAD at the moment, we what do we get for the Canadian data? Dollar CAD, Canadian data came in stronger as well. So with the dollar CAD trade, both of those two currencies slightly stronger. Generally, why I would avoid trading that particular asset pair, just because there's a lot that needs to line up for that to come in right. And this was also quite a big beat on the consensus 50, 25 consensus up to 90, and unemployment also down. So yeah, not very good for dollar CAD. And this is the worst case scenario of what you can have happen is a candlestick that looks like this. That is not what you want to see. Cool. All right. Anyone got any questions on this at the moment? We've kind of gone through that relatively quickly just because it's on a time. But if you have any questions now, please feel free to pop them in the chat box, and I can have a look at those. Yeah, absolutely. So no, so the options trade's still running. So the good thing about the options trade is since we haven't got a stop loss, that position will just continue to run until the end of the day. So the good thing about the options is as long as we find direction before the end of the day, that trade can still end up profitable. At the moment, it's not because we're still holding around there, but hopefully we get this move before the end of the day and we start to pick that back up. Let's show on euro dollar. IBD, expecting a bullish move. Yeah, so bullish move on the dollar is what we got. Now it's just a matter of which currency between dollar and the Canadian dollar ends up triumphing between the two. But this is a very bullish move for the US dollar. And the likelihood of this continuing for a little bit of time is probably quite high just because it was a big beat on the consensus. Parity, guys forget which way around that is. Down here, the 1-to-1 is ever more looking like it's in reach. That descending triangle looks like it's played out pretty well. Why cable went down? So cable went down because it's priced against the dollar. So when we're looking at this chart, it's how many dollars can our £1 buy? If our dollar increases in strength, our £1 can buy less of those dollars, and we saw that move down. And that's the same across any of those currency pairs. Right. What is the most you could lose? Depending on the trade, in an ideal scenario with this straddle position, we would be entered in one trade in one direction and we close the opposing order, as we've done here. Worst case scenario is we have this move and the order gets triggered long and stopped out, and the order gets triggered short and also stopped out. So two stop losses. How you choose to manage your risk during a data release is probably something to think about. You could do 0.5% on either side. So worst case scenario, you only ever lose 1% of your total account, which would be the same as one trade. So if you want to kind of think about it in the worst case scenario, that would be the way to do it. 0.5% on either side to limit your potential risk. So for the option straddle, we could lose both the contracts that we bought, which would be 250 a piece. You wouldn't lose all of that for both of them. You would lose all of it for one of them and either less for the other one, or we take a small profit on the other one. So generally we end up with either a small loss or we start to accumulate profits. This position at the top needs to exceed the £250 loss at the bottom. So we need to make back what we've paid for it essentially. But it has till the end of the day to do that. So what else have we got? Being closed out my phone account loss when it that is annoying. Yeah, it probably a slippage issue, I would imagine. How long to hold now? If you're still short on these positions, entirely up to you, right? We could either close the position now and say we've had this move. I was only wanting to trade that initial spike, and now I'm going to get out. My position was short from up here with a stop loss here. So this just ends up being a bit of an increase in it, a bit of a push further. But how you would choose to manage that, you could trail a stop loss. So we could say, let's see where the price is at the moment. If we get a bit of a pullback, I'm going to allow this market to come back to a retracement of that previous move down. And I am going to move my stop loss from above the top of the range to behind this 61%. And then if the market does retrace and it goes back to 61, it's probably going to end up retracing all the way back up to the top. Or you close it, take the cash, and come back for the next one. When it's high impact news, do you avoid normal strategies for the whole day? Do you do that? Yeah. So when we're trading it around news, you can probably have to come to the decision of this when you have your strategy as to will I just completely avoid data or not. So some people will say today is non-farm payrolls day or today is interest rate day. I am not going to trade for this day at all. For two reasons. Reason one is that that day could be quite choppy on the run up into the data release. As we said, people don't want to trade, people don't want to get into positions because that data is coming out. So the conditions on the run up to it, not very favorable. And then if they get into a position, whatever the strategy is, whatever your technical setup is, it is at the complete mercy of that data release when it comes out. Alternatively, you give yourself 2 hours either side of a data release, and that is your buffer to close trades and to not open trades. Just so you know, you can still trade, but you've avoided this area of actual data release and volatility after the data release. So that's probably where I would sit on that, a bit of a buffer either side of a couple of hours. Why did the cable go down? Yeah, so cable went down, good for dollar, so stronger dollar, and we saw that push lower. Now, why did the S&P go down? I would have thought the dollar doing good would mean the US economy is doing well. So yeah, that's why I don't really like to trade those during this period because it's good employment data, but stocks are down. It's ultimately going to be on the basis of what does this mean for the Fed? If this means that the Fed is going to continue to increase interest rates, or continue to hold interest rates or potentially increase interest rates, that is going to be bearish for stocks. So that is the reason that we're going to see that inverse correlation between the two at the moment is stronger dollar or that stronger data might be an implication of higher interest rates for longer, which is going to be bearish for stocks. Huge difference. Yeah, this is the ideal scenario, right? We get a big miss on a big beat on the consensus, way above the consensus here, and also outside of that range that we spoke about, that was 200,000. That was the highest anyone thought it would be, and we kind of smashed through that at 556. And unemployment was down, so it was a pretty perfect scenario there. Yeah, so just going back to catching up here, taking a straddle with both trades activated. Now, one of the things we spoke about before was on an asset before or as there's an extremely high amount of volatility that comes around before a data release, spreads are going to widen. And if we just look at this asset here quickly, I'll go down to a 1 minute chart. Nope. You can turn these on as well, bid ask lines, which is going to be the spread. These two lines represent the spread between where you would buy, where your broker would enter you for a long or a short, where they would buy or sell for you or off you. So these two lines that are floating around above and below the blue line are the spread. Now around the data release, this spread could widen quite drastically just on the basis of it's extremely volatile, it's a risky time to trade, the broker wants to take a little bit more commission on that trade essentially. And what can happen is that even before the data release breaks out, this spread is widened, we've been triggered in either direction, and we didn't actually break the range just because the spread is widened. So we want to make sure we've got a buffer between where the range is and where our entry is, just to make sure we've given ourselves enough space to try and to avoid those types of things. If you still a stronger, what's the K? Should it be up? Is it down? Sorry, down. Yeah. So for cable, all this chart is telling us is that um, we've got the base and the quote currency. So one pound is and that's the base currency. So we got our base currency, which is the sterling, and we've got £1 is just the kind of base currency amount. The quote currency, or ultimately what this price chart is telling us, is that for £1 we can buy X amount of the quote currency. So at the moment, £1 would buy $1.2214. If the dollar was to weaken, our £1 could buy more of those weaker dollars, and this chart would start to move up. Because in this case the dollar is strengthened, our £1 can no longer buy as many strong dollars, and this chart ultimately moves down. So at the moment, down here, if the dollar started to weaken again, our £1 could buy more, and we start to move up. And obviously the same is true for the pound. If sterling started to strengthen, our stronger pound could buy more dollars, and this would move up. If our sterling started to weaken, our weaker pound could now buy less dollars, and we would start to drift lower. That's kind of the shift in price that we've seen happen here. Strong dollar, nothing to do with the pound really. It's just the strong dollar, and in comparison to that pound that hasn't changed in strength, we can now buy less. Yeah, no, so yeah, it's always a base currency is one, always the first currency is always the base, and it's always one. So in this case, dollar Swiss, $1 can buy this many Swiss francs. Stronger dollar, our strong dollar can now buy more Swiss francs, and it moves up. Or potential pennants forming for those of us gone through price patterns. Pennant is a nice pattern to look for around these kind of aggressive moves and data releases. Just an indication of consolidation around the data release to either continue the previous move or potentially reverse it. So a nice one to keep an eye on there. Mine activated immediately before the data came out, so I thought, yeah, no, that wouldn't have been your fault, unfortunately. Morad, that was probably down to the spreads. We've had this happen to us on the webinars before. It's very annoying, especially when the move is nice. But it is still a good thing to see happen, right? Just so you're aware that those things can happen. If the spreads widen, you might be entered before the move actually begins. Similar move on sterling CAD. Let's have a look. Yeah, I guess sterling CAD lower on the basis of stronger Canadian data. Yeah, very nice. Yeah, good move. This as well is another indication of an extremely aggressive move. This could be essentially the same as slippage, but instead of actually having a candlestick, the price just completely jumps over. So if your order was in the middle here, you might have just missed that order, or it might enter you lower down, which obviously isn't ideal. Why last non-farm payroll, the figure was above consensus and it moved up. Let me have a look. Gold's back inside the range. Hopefully euro dollar continues. Sorry, what was that? Non-farm payroll last figure. Let's have a look. So last figure would have been December the 2024. Let's see. Let's have a look. Cool. So last non-farm payroll we had. Non-farm payrolls coming in above 200,000 at 227. Average hourly earnings 4%, and unemployment holding steady. Let's have a look. When was it? The 6th of December. January 18th, 6th. Okay, fine. Yeah, so that initial move we got up was bullish, and followed by a bit of a bearish move. That might have been because the data we had was after an extremely low non-farm payrolls, which kind of skews the data a bit. There was a reason for this. Whether the consensus ranges were higher at this time, I'd have to double check, but that might have been the case. Ultimately, the move continued down, but yeah, you would be right in saying that that move wasn't what we would expect, which can be the case sometimes, unfortunately, without too much of a reason. Normally, there is obviously a reason somewhere. It's just a matter of trying to find it sometimes. More volatility at 3 p.m. expected after Michigan. Yeah, definitely. So we've got the Michigan Consumer Price Index later on. If that comes out high, again, bullish for the dollar. If that comes out lower, bearish for the dollar. So that could just provide just a more of a catalyst to push forward, which would be good. And we also have the US Open. So at 2:30, the US comes in, and they then have the opportunity to trade this as well. Cool. All right, well done for anyone that traded alongside. A nice data release to see. Thankfully, we didn't get chopped up. We will try to do this again on any other major data releases we have coming up. If you are unsure about the strategies that we've just implemented, don't worry, we are going to come onto those a little bit later on in the course. But just a bit of a look at what we will be doing a bit later on. Cool. If you have any questions, feel free to ask away. If not, we'll finish up there. Obviously, any questions in the meantime, just pop us a message. But thank you all for joining. Cheers for joining a bit later on than usual. You'll obviously be back to normal next time. But yeah, that is non-farm payrolls. Perfect. Cheers, everyone. Have a lovely weekend, and I will catch you all at some point on Monday. Perfect. Cheers, everyone. Thank you.